Lindsay Rosner, Goldman Sachs Asset Management Head of Multi-Sector Investing, spoke with Wall Street Week host David Westin on where they're finding the best returns.
Yeah, so it's a really interesting environment right now. Yields are abundant. They abound. However, spreads are tight. So you really need to be thoughtful about where you are taking that risk. And to your question, where are there opportunities? Writ large, U.S. investment grade, very, very tight spreads. High yield, pretty tight, tighter than average as well. Where we're finding an interesting pocket is actually in structured product. And what I mean by that is commercial mortgage-backed securities, CLOs, even some asset-backed securities.
So why isn't the market pricing that accurately now? What's the market got wrong about that?
Well, I think it's not necessarily that the market got it wrong, but what's happening in the market has changed so dramatically. And just think about Fed funds and the expectations there. We started January, which was just 2 months ago, with 150 basis points of cuts priced in. This morning, it was 80 basis points. So there has been this repricing of what the Fed is going to do. And where we lived in 2023 and even started in January was a world in which the Fed may continue to hike or at least hike and hold. At those high interest rate levels, it is very difficult for some of the collateral and some of these different structures in structured product to give value. And one of the big things like commercial mortgage-backed securities, underlying it is commercial real estate. And we all know what's happened in commercial real estate. And so there was real concerns about if there is a wall of maturity, how does that get refinanced and at what rates? And again, the market was pricing in what those rates would be a lot higher, which decreased the value. Now, we had a really consequential CPI print in October, which told us, hey, a soft landing is very much on the table. And the deflation or disinflation is really taking hold. That has really changed that narrative that you see in the rates market. And for us, we believe that also changes the expected return or the outcome for various parts of structured products.
So pick up on that. I'm curious. There has been a real shift in the expectations about rate cuts this year. And some people think that's a bad thing because we won't have as many rate cuts. But I wonder if the reason the markets were pricing in that many rate cuts was actually the anticipation of a chance of a recession. And as that goes away, it actually reduces the need to cut rates.
So there is definitely less of a view of recession. Goldman had a fantastic call last year calling for a softish landing. I think it was lonely in that camp. Many were calling for a recession. And in fact, we really are getting a soft landing-ish situation. As that recession has really come off the table, and we saw a GDP revision come out today as well, showing strong GDP numbers. As that recession is coming off the table, you're absolutely right. The Fed doesn't have to do those insurance cuts to protect and not worry so much about the downside, protect the economy. Instead, they can be more metered and take some time to be sure that inflation is coming down and that growth actually is not reaccelerating too much. So there's kind of this like happy medium kind of channel they're looking for.
Well, and I don't want to argue against a happy medium. That sounds like a good idea. At the same time, right now, as we sit here, it looks like things are pretty good in the United States. The economy seems to be doing pretty well. The labor market's in pretty good shape. You know, the rates have gone up, but they don't seem to be going up too far. What is the risk we should be looking out for that we may not be missing? I think early on in your career, you had some experience with that at Lehman.
Yes, I did have some experience with risks at Lehman Brothers. I was 2 years out of college, as I like to say. I am not responsible. I feel like I have to put that out there. But I learned a lot. And what I learned, and it's never left me, is that you don't necessarily know what the risk will be, but risk will come. And I think this is the idea of the black swan as well. Yeah. And they happen with frequency. So it's important, especially when things feel really good, to say what could be the problems. A few things that come to mind. Number one, geopolitical. You can literally spin the globe, put a finger down, and you're likely to point out a geopolitical tension, flare, issue, or maybe even something more pronounced right now. Of the geopolitical issues that are out there, especially ones that started even in 2023 or earlier than that, they are unresolved. It's not like we've crossed a geopolitical tension or issue off the list and say, that one we can put aside, it's done. It still exists. So that's something that's really important to remember that can be out there. Now, what's been interesting in the market is typically when there are geopolitical flares, you see a flight to quality rally. People go into treasuries. That has not been the case. So there is this real exuberance and euphoria, and it's exactly then that we like to say, are we thinking about things properly? Are they properly valued? So geopolitical would be one thing that I would think about. The other one I think is just an interesting technical that's developed in the market, which is the private credit world has grown. And I'm sure you've spoken a lot on this show with people who are part of private credit or at least speaking about it. And it is a $1.7 trillion market right now. That's really big. We've never seen it this big. And the interesting dynamic is that money has been committed to it, but not all the capital has been called. So as you're a private credit investor, you're waiting for your capital to be called to go service deals. Where do you put it? And I think that's a big question. It's probably not sitting under a pillow or under a mattress somewhere. It's maybe in money markets, it's maybe in US investment grade funds, or maybe it's in public high yields because that is a yield more analogous to what investors think that they'll get in private credit.